If you bought or refinanced a home in Canada during the pandemic, the countdown clock is officially ticking down to its final seconds. The very last waves of those famous 1.5 to 2% fixed-term rate mortgages, accounting for nearly 12% of all outstanding mortgages in Canada, are hitting their 5-year renewal dates right now. And according to a brand new nationwide survey conducted by Royal LePage, 1 in 3 borrowers who have renewals coming up this year are feeling some heightened anxiety around what their new mortgage payment will look like. Now, if you are sweating your renewal date, here's why you need to stay tuned for the rest of this video. The widespread mortgage cliff or wave of heavy defaults that were in the predictions on many headlines for 2026, well, it didn't happen. But what is happening is a quiet, radical shift in how Canadians now spend their money, how banks are handling renewals, and what product, either fixed or variable, smart borrowers are actually choosing right now. In this video, we're going to be breaking down the exact numbers from the Royal LePage report, why 39% of Canadian homeowners are making a critical mistake on their renewal. We'll go over the regional breakdown and why some provinces are faring better than others, and step-by-step strategies you can use to cut down your monthly costs before signing your bank's next offer. Be sure to stick around. Up next on Halifax Home Guide. Okay, let's get straight into the numbers. Royal LePage partnered with the polling company Burson to survey over 1,100 Canadian homeowners who are actively facing renewals within the next 12 months. First, the good news. Psychological stress is actually down compared to 2025. Back in early 2025, a staggering 57% of Canadian homeowners who are renewing their mortgage expected their monthly payments to skyrocket. Today, that number dropped down to 38%. So why the sudden relief? It comes down to the Bank of Canada. After holding rates to fight inflation, the central bank executed aggressive rate cuts, bringing the overnight lending rate down to 2.25%, which has been holding for quite a few months now. Because borrowing costs came down from their mid-2023 peak, the jump from a 2021 renewal up to a 2026 isn't as brutal as people feared 2 years ago. Here's how the breakdown looks today. 38% of borrowers expect that their payment will increase. 26% slight increase, 12% a significant jump. 31% expected their payment to stay the same, and 17% actually expected their payments to decrease. As Royal LePage CEO Phil Soper pointed out, the overblown pandemic mortgage renewal scare is largely behind us. But managing doesn't mean that it's easy. And here's what really matters. Out of the 38% that expected their payment to increase, 76% say that it will cause some financial strain in their household. So how are Canadian families absorbing these extra costs without losing their home? National mortgage delinquency data from CMHC shows that the 90-day default rate for mortgages in Canada is remarkably low. Even in higher cost markets like Toronto, default rates are sitting at just 0.29%. Compared to historical averages and other developed countries across the world, Canadians treat their mortgage as their absolute last obligation that they fail to meet. Instead of defaulting or selling the homes, Canadians are making drastic lifestyle cutbacks. According to the Royal LePage survey, among those that are expecting strain, 58% are actively cutting back on discretionary spending. So we're talking eating out, retail, and entertainment. 48% are scaling back or canceling travel plans altogether, and 38% are delaying or canceling home renovation projects. Interestingly, 71% of homeowners are saying that they are not planning any major housing changes like moving or selling. Among those who are looking to drastically cut costs, only 7% are expecting to move into a cheaper region or city. 5% are considering renting out a part of their home, like a basement suite or a room, and 5% are considering downsizing to a smaller property. Furthermore, 8% of respondents said that they are going to increase their amortization period in order to lower their payments, and 6% reported missing at least one payment during their current term. Now, real estate in Canada is never a single national story. It's a collection of hyper-local markets. The survey showed massive regional discrepancies across the country. Let's look at the numbers for expected payment increases. Let's start off with Saskatchewan and Manitoba, which is the highest in the country at 43%, expecting their payments to increase. Ontario, Quebec, and Atlantic Canada are close behind at 39%, followed by British Columbia sitting at 37%, and Alberta, the lowest in Canada, at 29%. Alberta presents a fascinating case study. Homeowners in Alberta are the least likely in Canada to expect a payment increase on their renewal date. But among those who do expect an increase, a staggering 82% of people say that this will create a major financial strain, the highest strain level in the entire country. On the flip side, Quebec homeowners actually reported the least amount of strain at 65%. In high-priced provinces like BC and Ontario, local experts note that while overall anxiety is elevated due to high balances, homeowners have benefited from equity growth as well as the strict stress test that was put in place in earlier years. This brings us to the most shocking find of this 2026 survey, which is borrower indecision. Currently, 70% of Canadians hold a fixed-rate mortgage. However, looking ahead to their 2026 renewal, only 43% plan to lock back into a fixed rate, 16% plan to switch to variable, and a massive 39% of Canadians said that they are currently undecided. On top of that, 49% of Canadians say that they plan on staying with their current bank, while 44% say that they intend to shop around. If you are in the 39% undecided group, or the 49% who plan to automatically re-sign with their current lender, you need to stop right there. When your mortgage comes up for renewal, your lender will typically send you a letter within 3 to 4 months of your renewal date. And this is with their standard rate offer. Historically, banks rarely offer their lowest, most competitive rates on this first piece of paper. Because OSFI updated the mortgage stress test rules, uninsured borrowers renewing with their current lender don't have to requalify under these stress tests. But if you shop around, you can often leverage other lenders' rates to force your current bank to match lower prices. So whether your renewal is next month or later this year, here is your 4-step action plan to not only survive, but thrive through your mortgage renewal. Step 1. Start 120 days early. Most lenders allow you to hold your rate at 120 days before your term expires without penalty. Track your maturity date on a calendar and set a reminder for 4 months before. Step 2. Compare fixed versus variable rates. With the Bank of Canada overnight rate sitting at 2.25%, variable rates have become more attractive again. However, if you crave budget predictability, short-term fixed rates such as the 3-year term have become extremely popular over the rigid 5-year term. Step number 3, work with an independent mortgage broker. Don't solely rely on your primary bank's branch. An independent broker can shop around multiple different lenders, credit unions, and banks to find unadvertised special rates. And step 4, audit your budget before choosing your amortization. If your new monthly payment forces a shortfall, talk to a broker about re-amortizing your loan from a 25-year to a 30-year. This will definitely help lower your payments to a manageable amount. But I just want to add, definitely only do this as a last resort, because over the long term, by doing this, you will be paying much more interest. But you'll also want to look at your lump sum prepayment privileges, so that way you have the option to put money down on your principal should your income increase. So the takeaway from Royal LePage's 2026 data is clear. While the ultra-low mortgage rate is officially behind us, the predicted foreclosure crisis never arrived. Canadian homeowners are resilient, adaptable, and making real budget adjustments in order to get by. So now I want to hear from you. Are you renewing your mortgage in 2026? Are you on team fixed rate or variable rate right now? Be sure to drop your thoughts and questions in the comments below. If you found this video helpful, be sure to hit the like button and subscribe to the channel if you haven't already, and share this with somebody who has a mortgage renewal coming soon. And you can also reach out to me directly if you're looking for a recommendation for a mortgage broker. Until next time, thanks for watching, and I'll see you again soon.